What you're seeing is the fact that gold has done its job. They had a bunch of gold, they needed liquidity, and they sold it. There is a rush out of euros, there's a rush out of rubles, a whole bunch of fiat-denominated savings instruments into the largest and most liquid market in the world. Just the near-term impact of the Gulf being shut down, and not just for oil and liquefied natural gas, but for helium, for nitrogenous fertilizer, for nitrogen, for refined aluminum. The impact of a prolonged closure of the Straits of Hormuz, as in many commodities, means that the circumstance looking 3 months out, 4 months out, 6 months out, if there isn't a political solution, are fairly dire. Of course, the shipments are constrained, which is a problem. The second is the Iranians have attacked the Qatari export facilities and in fact destroyed 2 LNG trains. These LNG trains are what they extract the helium out of.
Helium, I understand, is used in electronics manufacture, semiconductor fabs.
The United States, with the assistance of Canada, could solve that problem. The impact of what we're seeing on asset classes like gold. What you're seeing is the fact that gold has done its job. It is a source of liquidity. There are various entities that have needed liquidity, in particular the government of Turkey, defending the lira against a very strong US dollar. They had a bunch of gold, they needed liquidity, and they sold it. Gold did a wonderful job. During a period of turmoil, it had a bid. The thing that perhaps has many people worried is that a lot of people around the world, rightly or wrongly, blame the U.S. for the conflict. And they think it's ironic that the U.S., having initiated the conflict, gets the benefit of a stronger U.S. dollar. Markets are morally agnostic. The U.S. dollar is the deepest and most liquid market in the world. U.S. Treasuries are the deepest and most liquid securities market in the world. From a conventional perspective, taught by 45 years of experience, the risk asset in the world is the U.S. dollar. I think people are paying attention to what happens between now and 6 months from now, not what happens in terms of the deterioration of the purchasing power of the U.S. dollar over a decade, a luxury which I have and they may not have.
Gold is being praised for stability, but the real story here is forced selling under pressure. As Rick Rule points out here, gold isn't just a store of value. It becomes a liquidity tool when systems crack, and that's exactly what Turkey demonstrated, defending its currency. What's not said clearly is that a strong dollar often reflects global distress, not US strength, especially when capital flees weaker systems into treasuries. Short-term survival is driving decisions, not long-term purchasing power, and that shift matters for portfolio timing. Next, Rick Rule discusses how this liquidity rush is reshaping currency flows globally.
The consequence of this rush to quality right now means that there is a rush out of euros, there's a rush out of rubles, there's a rush out of a whole bunch of fiat-denominated savings instruments into the largest and most liquid market in the world. If you look at the strength of the DXY, which is the index that covers the US dollar versus a basket of currencies, you'll see that the US dollar is very strong. Gold is, of course, denominated in US dollars, so US dollar strength often equates to a lower gold price. And, as I say, people have needed gold as a source of liquidity. Ironically, too, well, I guess we covered this, but there has been a flow of funds into, not out of, Treasury securities, particularly short-term Treasury securities. Until the U.S. gives a Treasury auction, nobody shows up. You can expect during periods of time like this, you are going to see U.S. dollar strength. Longer term, of course, a different problem emerges. We have gone from a period in the U.S. where it looked like our operating budget deficit would be $2 trillion to a revised outlook that looks like $2.8 trillion, which is to say the near-term strength in the dollar does nothing to solve the dollar's longer-term problems, which has more to do with the aggregate levels of U.S. debt. It's also worth knowing, Dunnigan, and this is interesting in many regards. Despite the preference of our political class, the U.S. government is beginning to lose control of long-term interest rates and, ironically, even short-term interest rates, despite the best efforts of the Fed and the Trump administration to jawbone down lower near-term interest rates. Near-term interest rates are rising. And this increase in U.S. interest rates makes the U.S. dollar relatively more attractive relative to other currencies. So European money and Asian money chases U.S. dollars, near-term U.S. Treasuries, in response to higher interest rates too. For me personally, I've been taking advantage of lower gold prices to increase my gold holdings at the same time that I have also increased my short-term U.S. dollar-based holdings. I would note to you, Dunnigan, that I proved to myself in 2009 and 2010 that I was capable of using gold as liquidity. In other words, I was capable of actually selling it and buying more attractive asset classes.
A soaring dollar looks like strength on the surface, but the underlying math tells a very different story. As Rick Rule points out here, capital is fleeing weaker currencies into US Treasuries, pushing the DXY higher while simultaneously pressuring gold prices downward. But here's the disconnect. This is happening alongside a projected US deficit, jumping from $2 trillion to $2.8 trillion, which historically weakens currencies over time. Rising interest rates are pulling in global capital now, but they also signal stress in debt markets. Next, Rick Rule unravels how investors should balance liquidity versus long-term wealth preservation.
I suspect that some of your listeners have a near religious attraction to gold, and they would be unlikely to use it as liquidity. In that case, they can't count it as liquidity. For myself, I like to say I save in gold and I maintain liquidity in US dollars. Right now, I'm very liquid, so you could argue that I actually save in both. But I do note also that I am philosophically capable of selling my gold if there is another investment class that I think represents a compelling enough bargain that I'm willing to draw down my savings to participate in it. You will note, by the way, that the country of Turkey did the same thing. High U.S. interest rates and the strong U.S. dollar caused the Turks to need to defend the lira to maintain domestic purchasing power, and they sold a bunch of gold, which is to say the Turks used gold as liquidity, as a store of value, and I personally do the same.
As I pushed on your one question when you said about North American energy independence, and I said, well, what about the bigger picture of our broader supply chain dependence?
Many investors claim gold is their safety net, but few are actually willing to use it when it matters. As Rick Rule points out here, if you're not prepared to sell gold during opportunity windows or crises, then it isn't truly liquidity. It's just a static store of value. The distinction becomes critical when interest rates rise and new asset classes become more attractive, as we've seen in past cycles like 2009 to 2010. Turkey's actions reinforce this reality. Gold gets sold when pressure builds. The real question is whether your portfolio is flexible enough to adapt. Next, Rick Rule talks about how energy constraints could reshape commodity pricing dynamics.
I'll do the same about if there was an existential shortage of available physical petroleum because of continuing supply chain disruptions and constraints of exportable oil to supply the needs of mining operations in countries where that's required for mining. Is it possible that you'd end up with kind of this counterintuitive that, oh, we can't get enough oil to do the mining, but that actually causes an increase in metals prices because of exacerbating the already looming shortage of metals to accomplish the things that need to be done?
I think the impact will be delayed, much like I think if the Persian Gulf conflict goes on too much longer, the prices that you'll see for cargoes of oil and natural gas will surprise people, even though they've risen. They've risen in anticipation of a shortage. If we need to begin to ration oil and gas by price, you'll see very different price levels. The same thing I would expect would occur with industrial materials. I think that if we began to experience energy-related shortfalls in copper production or iron production, the first move that we would see would be a sort of a moderate increase in iron and copper prices, the same way that we have seen a moderate increase in oil and liquefied natural gas prices as a consequence of the Gulf crisis. If that circumstance were to continue, if, as an example, the Australians were, and I'm not saying this is going to occur, unable to mine the Pilbara, the biggest iron field in the world, which is completely dependent on petroleum energy, if that were to happen, and you were to experience real production declines out of the Pilbara, then what you would see is iron priced in a way that reflected the fact that supply and demand got balanced by price rather than anything else. In other words, you would see much higher prices. I'm not expecting that we're going to see that, but I think it's something that people need to take into account. Ironically, the other could be true too. It could be that as a consequence of fear and increasing energy prices, that what I believe is an already existent global economic slowdown exacerbates. And that, as an example, base metals prices are impacted as a consequence of reduced demand from a global economic slowdown.
Rising commodity prices might not signal demand strength. They could be a warning sign of supply breakdowns. As Rick Rule points out here, energy shortages don't just affect fuel. They ripple directly into mining output, potentially constraining copper and iron supply even as prices rise. This creates a dangerous illusion where higher prices look bullish, but actually reflect system stress, especially if conflicts disrupt regions like the Persian Gulf. At the same time, slowing global growth could suppress demand, creating volatility instead of a clear trend. Next, Rick Rule discusses why this push-pull dynamic could define markets ahead.
I know that your listeners don't want me to say on the one hand and on the other hand, but that's the best they're going to get out of me because I don't know what's going to happen.
It sounds like there are major driving forces that can cause countercurrents that could create a lot of volatility in the next period of time. It sounds like there isn't a clear, compelling thesis that really emerges that says, oh, this is a one-way street, one way or the other way. It's like, oh my goodness, there's volatility ahead, probably choppy seas ahead. Any refining on that simplification of what you just said?
No, I think that's exactly correct. I think a lot of what we're talking about depends on whether or not there's a political solution to the Gulf in fairly short order. The impact, never mind the impact of an expanding war, never mind the fact that the current situation risks political and military escalation into something like a broader conflict between Sunni and Shia Islam, among other things.
Markets hate uncertainty, but what's more dangerous is when there's no dominant narrative at all. As Rick Rule points out here, we're entering a phase where multiple macro forces, war risk, energy shocks, and policy responses are colliding without a clear direction, which historically leads to sharp volatility spikes. This isn't a trending market, it's a reactive one, where positioning can flip rapidly around geopolitical headlines, especially if tensions escalate in the Gulf. Investors expecting clean trends may get caught off guard as conditions shift week to week. Next, Rick Rule discusses how supply chain choke points could trigger deeper disruptions.
Just the near-term impact of the Gulf being shut down, and not just for oil and liquefied natural gas, but for helium, for nitrogenous fertilizer, for nitrogen, for refined aluminum. The impact of a prolonged closure of the Straits of Hormuz relative to the importance in the supply chain that the Gulf region has in many commodities means that the circumstance looking 3 months out, 4 months out, 6 months out, if there isn't a political solution, are fairly dire. And I'm really being kind. Most people haven't paid attention to helium as an example because we haven't had a supply shortage. Many people think of helium as something that somebody puts in a balloon in a circus, and it is in fact that. But it's also an absolutely critical component in the manufacturing and operation of a whole bunch of computer and semiconductor related activities. About if my memory serves me well, 35% of the world's export supplies of helium come out of Qatar.
The real risk isn't oil prices, it's the hidden dependencies most investors never track. As Rick Rule points out here, a disruption in the Gulf doesn't just hit energy markets. It cascades into fertilizers, aluminum, and critically, helium, which underpin semiconductor production. That 35% export concentration is a structural vulnerability, especially in a world already strained by supply chain fragility since 2020. If this disruption lasts even 3 to 6 months, it could quietly pressure tech manufacturing and industrial output. This is how inflation shocks reappear unexpectedly across sectors. Next, Rick Rule unravels how physical damage to infrastructure worsens the timeline.
Two things are happening there. The first is that, of course, the shipments are constrained, which is a problem. The second is that the Iranians have attacked the Qatari export facilities and, in fact, destroyed 2 LNG trains. These LNG trains are what they extract the helium out of. So it isn't just that helium shipments will be constrained militarily. It's that the means of production in certain cases have been destroyed and will take between 2 and 5 years to rebalance.
This helium, I understand, is used in electronics manufacture, semiconductor fabs worldwide. When we were talking about U.S. independence in some forms of energy, there have been analysts who've been calling for over a year now, saying people should look to U.S. fabs like Intel rather than foreign ones that are more under contested geographies and that sort of thing. But what about the ability of the U.S. fabs to obtain helium? Is there any concern that, gosh, we all get it from the same place, it's going to affect everybody?
I would suspect
supply shocks don't just disrupt prices. They break timelines in ways markets consistently underestimate. As Rick Rule points out here, the destruction of LNG infrastructure means helium production isn't just delayed. It's structurally impaired for potentially 2 to 5 years, which is a completely different risk profile. That creates a bottleneck for semiconductor fabs globally, including US-based players like Intel, despite the narrative of domestic resilience. Investors focusing only on geography are missing input dependencies that don't respect borders. This is where production optimism can quietly collapse. Next, Rick Rule discusses whether North America can realistically replace that lost supply.
The United States, with the assistance of Canada, could solve that problem. We have underinvested in U.S. helium, not as a policy choice, but rather because Qatari and Kuwaiti and Saudi helium was cheaper. We have a lot of helium in North America to develop, but we have to develop it. Remember, the helium ultimately is a gaseous expression of the decomposition of uranium. Traditionally, the biggest source of helium in North America has been the Hugoton embayment in northern Oklahoma and southwest Kansas. That field has been produced for so long, since the 1930s, that it's under-pressurized and is falling. But one would expect that the gaseous trends in South Texas, adjacent to the in situ uranium deposits in South Texas, could increase in stature. My money really would be on Saskatchewan. I believe that within 6 to 12 months that you could drill out enough helium in Saskatchewan that North America would be relatively sheltered from the impacts of constrained helium shipments from the Persian Gulf.
Resource availability isn't the problem. Investment timing and incentives are. As Rick Rule points out here, North America has the capacity to replace lost helium supply, but only because prior underinvestment created this gap when cheaper imports dominated. The key issue is whether capital flows fast enough to develop new supply within that 6 to 12 month window, especially as interest rates remain elevated. History shows resource development often lags demand shocks, creating interim shortages that hit industrial users first. Investors should watch capital allocation trends closely. Next, Rick Rule talks about which players could capitalize on this shift.
Now, make no mistake, in a world unconstrained by war, the supplies of helium from the Persian Gulf would be much, much, much cheaper than North American helium. But to the extent that those supplies weren't available, all of a sudden North American helium becomes extremely competitive.
So help us a little bit more. You said you could obtain helium from that region in Saskatchewan. Are there particular companies that you follow that seem to be better positioned than most at being those who could?
There is one that's private, but the truth is that Whitecap or any of the Canadian gas producers could, if my thesis holds true, come into southern Saskatchewan and begin in drilling those gas fields and extracting helium. Yes, I have made a bet in that field in a private circumstance, which is not available to public subscribers. But I wasn't actually trying to hint at anything. I was just suggesting, in response to your question, that North Americans should consider themselves fortunate in that our supply constraints are more policy-related than resource-related.
What looks like a cost disadvantage can quickly flip into a strategic edge under the right conditions. As Rick Rule points out here, North American helium is normally uncompetitive due to higher production costs, but supply disruptions instantly change that equation, making local production economically viable. This is a classic example of how geopolitical shocks reshape commodity curves and create unexpected winners. The overlooked angle is that policy and capital access, not resource scarcity, will determine who benefits. Investors tracking early movers could identify asymmetric opportunities here.